Gold serves a very important place in monetary reserves. And the question is, why do central banks put money into an asset which has no rate of return, but cost of storage and insurance and everything else like that? Why are they doing that? If you look at the data, with a very few exceptions, all of the developed countries have gold reserves. Why?
Gold is the one neutral reserve asset, the one neutral barometer by which we measure anything. And so rising gold is good not only for all the world's central banks, not only for the United States, but it also devalues the dollar and allows us to bring back manufacturing. I think it's actually what the U.S. government wants at this point.
Gold is quietly sending a message that many investors are still ignoring. While headlines remain focused on interest rates, politics, and economic uncertainty, central banks continue accumulating gold at a pace that suggests something much bigger is unfolding beneath the surface. Andy Schectman, a leading voice in the precious metals industry, highlights a theme increasingly supported by global reserve trends: gold is not merely a commodity, but a critical monetary asset. The continued accumulation of bullion by central banks points to a growing recognition that physical gold remains one of the few universally accepted stores of value outside the traditional fiat system. The discussion emphasizes that gold occupies a unique position in the global financial architecture. Unlike paper currencies, it carries no counterparty risk and does not depend on the promises of governments or financial institutions. That characteristic has become increasingly important as nations reassess reserve strategies and prepare for a more fragmented economic environment. Rising gold prices may therefore reflect more than investment demand. They may represent a gradual revaluation of monetary trust itself. If this trend continues, the precious metals sector could benefit from a structural shift that extends well beyond short-term market cycles. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold is a currency. It is still, by all evidences, the premier currency where no fiat currency, including the dollar, can match it. And so that the issue is, if you're looking at a question of turmoil, you will find, as we always have in the past, it moves into the gold price. But the gold price is actually half a commodity price. So when the economy is weakening, it goes down like copper. But it's also got a monetary characteristic which is intrinsic. It's not inbred into human beings. I cannot conceive of any mechanism by which you could say that, but it behaves as though it is. Intrinsic currencies like gold and silver, for example, are acceptable without a third-party guarantee. For example, at the end of World War II, or just at the end of it, Germany could not import goods without payment in gold. Gold serves a very important place in monetary reserves. And the question is, why do central banks put money into an asset which has no rate of return, but cost of storage and insurance and everything else like that? Why are they doing that? If you look at the data, with a very few exceptions, all of the developed countries have gold reserves. Why?
I mean, I don't know if there's a bigger endorsement I've ever heard than that.
Why indeed? And they're only increasing their gold reserves.
That's a man clearing his conscience, man. That's what it is. He also came out and said that, investment in gold now is insurance. It's not for short-term gain, but the long-term protection. He's clearing his conscience there, and he's right. He's right, and I don't know. I just think that everything he said is spot on. And you look at any time in history since 1971, when we closed the gold window, and measure an ounce of gold in dollar terms, and look at what's happened to the value of the dollar. 71, $35 was an ounce of gold, and now it's 4,100. It's lost 1,500 times, percent, and 150. No, it would be 1,500%. I think that's right. Is that right? Pretty sure that's right. Anyways, the point of it is, it's a big gain, and the dollar's lost a ton of its value. Anytime in history, going back all the way forward, you will see the exact same thing. Anything you could buy with the dollar equivalent measured in gold, prices are going down. I look at him as a very smart man who sold out his beliefs. And and presided over.
Did he sell out his beliefs, though? I mean,
Yes.
this was the system. He couldn't reinstate a gold standard, even if he wanted to, as Fed chair.
But he expanded the fiat system and allowed a lot of these booms and busts to happen. And to me, all the central bankers, from him, Bernanke, Yellen, all of them, they've done nothing to add any benefit to this system. In fact, they've distorted it and perverted it, and created misallocations of resources, distortions in asset prices by suppression of interest rates. And really, that's really what it is. You look, since he was Fed chair, since 1982, moving straight down at a 45-degree angle, you see interest rates until just recently. And those were controlled by the Federal Reserve, not by the market. So by suppressing interest rates, it got us into the problems we have now. Maybe it was because we were offshoring our manufacturing, so we had to find a way to create prosperity, or the illusion of prosperity, and that was through suppression of interest rates, rather than letting the market do its own work, like a fire in the forest. It's tragic. Animals and trees and things die. You come back 5 years later and it's healthier than ever, filled with life. We've never let that forest fire to clean the underbrush. And it starts with suppression of interest rates, and Greenspan was as much to blame with that as anybody. You expand through suppressing interest rates to create an illusion of wealth, of prosperity. And that's really the biggest problem of everything. That's how all of these issues of valuation have been distorted and perverted. And what is something worth at 3%, 5%, 10%? Look what Paul Volcker had to do in 1980. He was the last politician with real courage who came in, and I don't know if you can call him a politician, but came in and raised rates to, almost 20%. And well, that had a lot to do with inflation and took care of it. So,
and we also saw what that did to gold prices.
and did to the market, and did to the bond market, and to the housing market, and to the employment situation. And it was, higher rates is what this market, or what this economy needs. But the reason they can't do it is because of the decades of perversion of low rates that created asset prices that will have a religious experience if they meet those kind of interest rates. The bond market would collapse, the stock market would collapse, the housing market would collapse, the banks that are loaded with treasuries would collapse, the insurance companies and the pension funds would all collapse. This is what happens when you mess with Mother Nature. You mess with Mother Nature by letting the central bankers control the interest rates, rather than letting the market say, well, there's risk there, and that risk, I think, deserves this rate. And all of those people looking at those fundamentals come to an agreement on what interest rates should be. When controlled by the Federal Reserve, look, we had far less inflation, far more prosperity prior to 1913, I would argue, on an individual basis, than we have after the fact, because it's like you said, it's destroyed the value of our currency. And saving in dollars really is not a way to prosperity. So you're forced into investment, which then pushes the stock market higher. And I don't know. And by suppressing interest rates, pushes the bond market higher. This is all synthetic and orchestrated. And these problems have to be resolved at some point. And normally it would be by raising interest rates. You do that now, well, that's a whole nother ball of wax that we'd have to deal with. But maybe that's in our future. Maybe the market says enough of this. Rates have to go higher. And you see what happens. There are those with their infinite wisdom that think if the Fed doesn't lower rates, gold can't go higher. It's the dumbest thing in the world. We've been, I think, brainwashed into believing that the Fed has to come in and rescue the day. Well, that's exactly the feelings that the big bankers have had forever. They can gamble and gamble and gamble. And, if they hit it big, they get huge bonuses. And if they screw up, well, the Fed will bail them out.
Hence the Greenspan put.
Right. And that's the problem. And that has to end. And maybe Warsh finally has the courage to do that. But we'll see how much courage he has when, unemployment is raging and Congress is screaming and people are losing their jobs and, the stock market's tanking. And will he have the courage to stay that path? Don't know. We'll see.
A key argument presented is that gold continues to function as a currency, even if modern financial systems rarely acknowledge it as such. During periods of uncertainty, capital naturally gravitates toward assets perceived as reliable stores of value, and history repeatedly shows gold playing that role. The analysis notes that gold possesses both commodity and monetary characteristics. Economic slowdowns can temporarily pressure prices, much like other raw materials, yet its monetary appeal often strengthens when confidence in financial systems weakens. This dual nature helps explain why gold behaves differently from most traditional assets over longer time horizons. As governments confront rising debt burdens and persistent fiscal challenges, demand for monetary alternatives may continue expanding. That environment could provide ongoing support for physical precious metals, particularly if investors shift from focusing on short-term volatility to long-term wealth preservation. Now let's get back to the interview.
So they're trading on forward guidance instead of real data, and that's a problem, and it's given a rise to irresponsibility by the big banks. I'm excited to see if Warsh actually follows through with that. I really am, and because as it pertains to gold, it's often punished like now, where because the fundamentals, not because fundamentals have changed, but because traders are front running the Fed, thinking, well, if inflation is running hot and we're in the middle of war, which should be good for gold, well, the Fed is going to do what they can to fight inflation, which is to raise rates or not lower them. So that's bad for gold. And all of these things I think are silly, and it's an old system as far as I'm concerned, and triggering selling or buying because markets assume higher or lower rates. And so in and of itself, I don't like that kind of Fed intervention. I think, in fact, it's interesting. If you look at this new guy, this Paul Winfrey, who is now advising Warsh, his whole idea is that you tie gold to the system because it's the booms and the busts that we see are largely a result of the central bank interference. And so when you use gold kind of as the guardrail or the governor to the system, it helps remove the booms and the busts that we typically would see via central bank intervention, lowering rates, raising rates, doing whatever they need to do. And I think it's interesting when you look at some of the quotes that Greenspan wrote. In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. Gold stands in the way of this insidious process. It stands as a protector of property rights. Maybe he was rolling around with Ayn Rand and in those circles, so he understood hard money. But I think one of the ones that I always clung to was that if gold was merely a barbarous relic, central banks would not continue holding large quantities of it. In fact, they continue to buy it. And I think that it's too bad that a lot of us in the gold community kind of think of him as a sellout, because in his early career, he was very big about gold.
Yeah.
During his tenure as the Fed chair, he ran the biggest fiat system in the world and allowed it to get out of control. And then as he got older, he went back to it. And I think that he said something that caught my attention. He said, Greenspan argued late in life that many of today's fiscal problems would have been far less severe under a gold standard. We never would have reached this position of extreme indebtedness were we on the gold standard. Yet during his tenure as the Fed chair, he said there's no way we could be on a gold standard. So,
He's not wrong. I mean, both are right.
Well,
as a Fed chair, you can't be
as a Fed chair, right. So at some point, you sell your soul, I guess. One of the things that I would never do, ever, and I mean this sincerely, ever, is to compromise my beliefs here, running my business, and certainly at the highest level. I would sooner say thank you, but no thank you, I can't take this appointment, if I had to completely go against my belief structure. And in essence, he did. And the beginning of his career before he was in the Fed and later in his life, he came out and more or less cited that. Who is going to buy our treasuries right now in the absence of the Federal Reserve, or in the absence of the United Kingdom and the Cayman Islands? These countries that are buying our treasuries, which is silly. And, you look at Japan, they were forced to buy treasuries right now. They need to only because it is the collateral by which the system works. They're not buying it for the yield. And I think that this is a system that is sick at its very core. It's sick. And I don't know what the ultimate outcome is, but certainly Warsh is right when he says that the markets need to react on real up to the moment information, not front run what they expect the Fed to do in reaction to inflation or to deflation or whatever it is that they are reacting to. And the big traders know this, and then they front run the public, and it's created a situation that is just I don't think it's not sustainable.
The tail wagging the dog.
Yes. I mean, ultimately, I see gold moving higher because of the mechanism that I'm focusing on, and that is the Genius Act suppressing the front end of the curve, the interest not being transferable, central banks continuing to buy it, and rising gold is the one neutral reserve asset, the one neutral barometer by which we measure anything. And so rising gold is good not only for all the world's central banks, not only for the United States, but it also devalues the dollar and allows us to bring back manufacturing. I think it's actually what the U.S. government wants at this point. Now, maybe they're the ones that are at the forefront of bringing the paper price down right now so they can stand for delivery easily. Could it be? Could it be that the people that are really trying to stand for delivery have the ability to create money, suppress the forward futures price, and then say, we're going to take the actual physical bars this time. Thank you. The numbered bars, please, not the warrants. Could it be? Just saying. I think it could. Why not? Who's going to slap their wrist? Or certainly the big in the know traders that are doing that. So, because it doesn't make sense to me in this environment that gold and silver wouldn't be flying. It is that counterintuitive behavior of gold and silver that really is too much for most people to deal with. And but if you take a step back and see the deliveries, the rhetoric by some of these very large institutions that are quietly speaking their intentions, I think betray the price. I can't see any way that gold and silver don't go ultimately, mostly gold, especially, ultimately go higher. And I am not disparaging silver. I just think gold is going to be vital in the global monetary system. Silver will come along for the ride, but I think ultimately gold will be the one asset that is agreed upon globally as that one neutral barometer, that one neutral reserve asset that allows everyone to agree upon this is something that I would take for settlement. It just seems to be that's the way it's going.
One of the most important observations is the continued commitment of central banks to holding and expanding gold reserves despite the absence of yield. Storage costs, insurance expenses, and the lack of interest income would normally discourage ownership. Yet official institutions around the world continue to increase their allocations. That reality alone speaks volumes about gold's strategic importance. The broader implication is that nations are preparing for a future in which diversification away from excessive dependence on fiat currencies becomes increasingly necessary. Gold remains one of the few assets that can serve as a neutral reserve, accepted globally without requiring confidence in a third-party issuer. Historical examples have repeatedly demonstrated that during periods of financial stress, physical gold retains purchasing power and international acceptability when other forms of money come under pressure. If reserve accumulation continues at current levels, the long-term outlook for precious metals may remain exceptionally constructive. Growing geopolitical fragmentation, persistent sovereign debt concerns, and efforts by many countries to strengthen financial resilience all point toward sustained institutional demand, rather than viewing gold solely through the lens of daily price fluctuations. Investors may benefit from recognizing the larger trend emerging across the global monetary system. The steady actions of central banks suggest that gold's role is expanding, not diminishing, within the next phase of international finance. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.